Can you guys hear me okay? I just want to make sure that the sound is working. And awesome. Thanks, Rich. Nice. We have some new people. Okay, so excited. So we have a special surprise tonight. We have a gentleman named Derek that he actually owned a stock brokerage company, and he's going to jump on and play with the Fibonacci overlays, but he's having a little bit of, oh, he's on. Awesome. Derek's going to get on, and this is going to be his first time working with Joe's Fibonacci overlays and their crypto. Actually, he doesn't even use the crypto bull radar. So I thought we would put this to the test, and we'll let a full-time trader that used to own his own firm jump on and use my trading view account and well, actually, because he's going to use Joe's overlays and so forth. So he can go through that and teach us a little bit of historical information of Fibonacci, what it is and why it's so powerful, and a little bit of perspective of a real-time trader that's been doing this for 30-something years. So, and then this right here, what you're looking at is just a review of yesterday. If you guys have not gotten the replay, I pretty much sent it out, but it's just, this is yesterday's Wednesday webinar. It's just an overview of the product line. So you have Crypto Prophecy. We're looking at the control panel showing you waves was really like 3 steps down. Ontology was 3 steps up in price, showing you how you could kind of captivate a good perspective of where the market is at that moment. Then in Crypto Prophecy, you have that trading tool where it shows you if I invested this amount of money, when it hits the all-time high, what could I potentially have in the future? For the people that just don't want to do swing trading, they just want to hodl, which is hold on for dear life. And then we jumped in and did a little bit of trading view perspectives with Renee from Germany. And so he had asked me to give you guys his email address. And so we did. All right, so that is that. And then we ended. And now we are going to jump on. And I'm going to make Derek the presenter. So Derek, you are about to get the screen, and we're going to put this to the test. All right, Derek, I think I can hear you.
Can you hear me?
Yes, I'm so excited. You guys are going to love Derek.
All right. So my charts. I'm sorry if I'm a little confused here. I am logged in as you. I can see that I am over here, but I don't seem to have the fib lines on these charts now.
Okay, so guys, this is going to be really fun. So any of you that already have the overlays, if you want to jump on this and we'll kind of talk Derek through this, we could do that too. So, and this is really good. So you guys understand when you're looking at Trading View, you'll see what a real trader is going to go through. You just did it.
There. Okay, so they only show up in the hourlies. They're not showing up on a daily.
Correct. He programmed it for hourly. You're right.
Okay, check. Got it. All right. Welcome everybody. And I am gonna, I guess if you want to kind of walk me through the basics, of what he's set up, because like you said, this is literally my first 5 minutes of looking at it.
Yeah.
So these are obviously fib levels. Do you know what he used? Is this a 618? Is this a 38? Do you have any idea?
So no. So why don't could you tell us a little bit about fib lines and how there are options? I mean, I think what is amazing about your perspective on this product line is that you understand fib so much because you've read over 1,000 books on trading that you could explain to us the difference, because as consumers, we don't really know. So could you tell us the options? And this is good. We'll circle back with Joe's just sick tonight. Wonder if you'd hop on and just tell us. I'll text him while we're on the phone.
Okay.
What's the question? I'll ask him.
Well, I'm just curious what each of these lines, what actual fib. I'm assuming he probably just used the baseline of 0.618, but that would be, the norm. But I don't know, and I'm just guessing. And then this might be a 1.618, and exactly the opposite here. the inverse, but I'm not, I'm guessing. So, trying to get more data in here. Let me move to a 4 hour. Okay.
See how the fib lines change on the 4 hours? And so one of our traders, Donna, she does a lot of the paper trading in TradingView, and her trades were just hitting the wrong numbers. She wasn't winning the trades because she wasn't on the 1 hour, but she was doing what you're doing, condensing the chart. So when you're making and you're drawing, guys, Derek is in Crypto Renegade and he teaches all the chart reading. And, you know, he knows how to draw the lines himself and overlay them. So could you explain what happens when you condense the charts with the fib levels?
Well, here, let me do it.
Manually?
Yeah, the old-fashioned way. Do you mind if I turn all this other stuff off? Because
Go for it.
it's all great, but I don't need it.
So
I
you're
don't
just
even.
gonna click on that chart, click on that area you want to remove.
Okay.
On the right, yeah, you got it.
I don't want to remove all because then I'll get rid of this. There we go. Okay.
Guys, whatever, Renee says, hi, Derek. If anyone wants to
Hey,
be
Renee.
unmuted, let me know so you can ask Derek questions while we have the expert on the line. And Derek, tell us a little bit about your history. Like, what was the company that you owned and about how much money were you managing?
Okay. Well, my history is, like you said, I've been doing this for too long. Since I was 15, I got started actually, and I'm 46 now, so it's over 30 years. And I started at the age of, like I said, 15 to 18, just kind of trading through my dad's account, saving up my own money, working at a gas station down the street. And when I was 18, I had saved up $3,000 and I started trading commodities, futures. My first trade was in cocoa. I bought it on a Tuesday, sold it on Thursday, made $600 on a $400 investment, and thought I was king of the world. And you know, that kind of set me on that path from there on to this day. And anyway, long story short, I ended up working at Merrill Lynch for a little bit, and that led to me working at a commodities futures firm. And I went pretty quickly from being a broker to being the branch manager to then being the head trader within a couple of years, and then ended up breaking away and starting my own firm. And then I built that firm up and sold it literally 2 weeks before the crash back in 07. So I did not know it was coming. I just got lucky. It took over a year to put the deal together. So anyway, better to be lucky than good. We specialized in trading futures options, which is, you know, kind of very esoteric. So we did all kinds of strange things like butterfly spreads and jelly rolls and all kind of just weird option spread strategies, which we don't need to get into right now. But we managed, that was private clients. So we managed, we had a few $100 million under management. But it was all, you know, private client money that we were just helping advise. And then after that, I did manage a hedge fund as well. That was pretty much self-funded, most of my own money, and a couple of private investors as well. So yeah, I mean, trading has been my whole life. And so what I'm going to just basically walk through here is I'm just pulling up Ethereum US on a 60-minute basis, and I'm just going to actually kind of go through it the way I would look at it, regardless of all the other stuff that's on here. So I'm going to actually use the I think it's over here, the old-fashioned Fibonacci Retracement tool, which is what I'm used to. So all I'm going to do here, just to explain it, I'm just basically roughly drawing out the most recent high and the most recent low that we've had on this chart. if it lets me. Okay. And so this is going to basically give me my basic fib area. Each one of these, so I guess I can give you a quick history of Fibonacci. For those who don't know, Fibonacci is a mathematical constant in nature. You find it in over 93%, 97%, depends on who you want to believe, but whatever. Over 90% of everything in nature is fundamentally constructed via the Fibonacci sequence. Everything from, the obvious things like the Nautilus shell that everybody sees, the sunflower, the tree is a pretty obvious one. Your whole body is constructed via the Fibonacci sequence. The spacing between each knuckle, is a 1.1618 extension of the previous knuckle. Like if you look at your forefinger to your first knuckle, and then you measure that, if you assume that distance is a 1, then from your first knuckle to your second knuckle, if you measure it, it should be exactly 1.618 the distance of, like I said, the tip of your finger to the first knuckle. And the same with, if you assume that second knuckle is now a 1, and you look at the second knuckle to your third knuckle, you're looking at another 1.618 extension. And the same thing happens with your forearm to your from your elbow to your shoulder versus your elbow to your wrist. That's a 1.618 extension of the of the upper arm. And same with your legs, everything. So it's ridiculously prolific throughout nature, to the point where it's undeniable exactly what it is or where it comes from, but it's there and it shows up in just about everything. So we use it in trading, because when you're looking at a chart of Ethereum in this case, or IBM or gold, or it doesn't matter, because the underlying chart is not an actual price or chart of price or value or any of that other BS, frankly. It is a chart of human emotion and the human feelings and belief of the perceived value of whatever that thing is at that time. I mean, at the end of the day, if you study the stock markets the way I have and the history of it, everything ultimately goes to zero. Everything is ultimately a buggy whip. If you look at the Dow, every company that was in the original 30 Dow 30 Dow stocks is now gone. GE is the only one that's still in existence, and they just removed that from the index. So, it ultimately, so the value, you know what I mean? My point is the value of all of those companies at one point was extremely high, and that's all, it all ultimately goes away. So whatever, it's just a cycle. And the thing that is constant is the human emotion. And that's what you're seeing when you see these chart patterns. When you're studying chart patterns, don't get lost in the math and don't get lost in like the mysticism of the fact that they repeat. It's not, these chart patterns are not repeating. It is simply the human animal that is repeating itself over and over again, because we respond almost identically to stimuli, no matter what. No matter if you're trained or not trained, it doesn't matter. If somebody walks up to you and slaps you across the face, you are pretty much going to respond the same way everybody else would. You're either going to slap them back or you're going to run. There's not really much of a third choice. So that's all inherently embedded in the market, and all of those things are what we, like I said, that what we see as recurring chart patterns. And I've studied, the chart patterns all the way through to the extremely weird esoteric stuff, including using the cycles of the moon and beyond. So that, Mercury's in retrograde, all that kind of stuff, and embed that into the charts, which you can do, to the very basic stuff that you probably all learn in the very beginning when you just start on the road to technical analysis. And I'll tell you the truth, for me, after doing this for now, like I said, 30 years, I only use the basic stuff now. You remember, I don't know if you've ever heard of that book, Everything I Need to Know I Learned in Kindergarten. It's the same thing with trading. Everything I actually needed to know that I actually use to make money, I learned in like the first few days of trading. And then you try to make it so much harder with everything else. And anyway, I've come full circle and I'm back to the basics. So Fibonacci is one of those absolute basics for me, even though it may sound like some esoteric math. It's very basic just because, like I said, if you look anywhere around you in nature, it's right there staring you in the face. So why would it not be right here in the markets? So here you have your basic area. And like I said, all I did is I'm just using what's here on the chart. I didn't even like shrink it down or anything special to like force this or whatever. I'm just literally connecting highs to low or lows to high. And then each one of these levels in here is going to basically can be used as a support and resistance level, which of course then can be used as buy and sell signals. So obviously we can use the benefit of hindsight for a minute here, but then we'll work on projecting it forward and actually using it in real time. But I don't want to take up too much of your time either, but I will try to make it quick. So
yeah, we love this. This is great.
Okay, cool. So without getting into the minutia about what each one of these Fibonacci numbers is and why they matter, basically the baseline number is this 0.618. That's the main number that is Fibonacci. That is the Fibonacci ratio. And so every other one of these numbers is some form of a derivative of that. It's either a square root or a reciprocal or whatever. So that none of that really matters other than curiosity. It's not going to make you a better trader to know that stuff. But what you would know is, and you can see it here, it's obviously I didn't even, like I said, all I did was draw this thing in from high to low. Didn't do anything special. I'm not forcing this. I didn't pre-look at this chart, not for 5 seconds before we started this webinar. But you can see it's literally almost to the letter using these lines as support and resistance levels. And that's not random. It's not by accident. There are no accidents. There's absolutely no mathematical way you can prove the possibility of randomness. It does not exist. It's a made-up idea. But anyway, so just with a little bit of, just using the benefit of hindsight here, you can see what where the support levels are. Clearly, in this case, the 0.618 is a support level, and then the 786 is a secondary support level down here. So if you're looking for basically buy signals, which I know most of you only have the opportunity to go long, so I won't get into going short and all of that, but if you're basically exclusively looking for buy signals, well, here you have another way to find them. And like I said, it becomes inherently obvious where they are and where the actual natural support level is. Again, this is coming out of nature. So this is and for whatever reason, I'm not going to get into the why and all that because it really doesn't matter. It doesn't, and I don't pretend I actually know it either. I have my own theories, but it doesn't matter. And it doesn't make you a better trader to know the why. It only makes you, you don't need to know why a car works. You just need to know how to drive it to be a race car driver. So, anyway, clearly, like I said, you can see buying the support level, that is the 618 in this case. And that doesn't always have to be the 618. I'm not saying it very often is, but it doesn't have to be. It could have been anywhere. But it almost always would have fallen on one of these lines. So in this case, it happened to be the 618. So you can see, if you just simply use the 618 as your buy and use the 786 or slightly below it as your stop level, you would have been buying low, each time here, even on these little rallies. And then down here, you still would have held on and your stop would have held below the 786, and then you would have caught this entire rally. So it's right there. You know what I'm saying? Like, it's kind of staring you in the face if you just kind of know what to look for. So that's how I use Fibonacci in a nutshell. I mean, there's more to it, and that you can, like I said, I can make it a million times more complicated, and I have, but it hasn't made me any more money. So it's made more work. So honestly, I don't know how that exactly corresponds to what you guys have going on here with the auto fib painter that it is. But anyway, any questions? What do you want me to? Does that make sense? I mean, I hope it's not too simple, but
Donna, Are you okay if I unmute you? Because Donna is infatuated with the Fibonacci lines, and she was the one that was so excited to be able to get you tonight when I found out that Joe was sick, is because Donna's like, I want to know more about Fibonacci. And she's a psychologist. So this is probably very fascinating to her, too, on a psychological level. So,
Yeah,
Renee,
go ahead.
totally, Derek. So, Donna, would you be okay if I unmuted you? So she said, yeah, sorry, Donna, you're unmuted. Go ahead, talk to Derek, and anybody else that wants to ask Derek questions, let me know and I'll unmute you.
Okay, so first of all, let me clarify something. These are different, this is a different Fibonacci system than the one that we've been using, correct?
Yeah, I was just going through like I said, this is an old-fashioned, the way I learned literally 30 years ago or 25 years ago when I learned Fibonacci. Still on old paper charts, old hand, when you would literally draw them out on graph paper. So this was just, you would just, like I said, just get a simple overlay of where your actual fib levels are. And then, like I said, inherent, almost always, it's, there's obviously a few exceptions, but we can go through, we'll pull them up and we'll go through whatever markets you guys want to. And like I said, you'll see it, that it's going to kind of naturally find whatever support level it is. Very often it centers around that 618, but it can be any of them, like I said. And then you'll even notice that a lot of times, for instance, the targets coincide and the peaks coincide with some of these other levels. Obviously, it can't use the peak because that's just a 0 point. But even this 28 or 236 level was a bit of resistance, and then it actually became support once it finally broke through for a brief moment and then fell back through it. So, and same thing on the way up here, the 2-3 level was a target and kind of a magnet, a sticking point, if you will. And then, like I said, none of these, this is not random. I can assure you that it's not random.
So how does this relate to the bullish and bearish line that we're doing with Joe's thing? Would that be placed inside of this somewhere?
Yeah, I mean, basically, it gives you that much more of a buy signal. If you're in the bullish phase, if it's that thick green line, basically, right? Then that's when you would want to be taking these buy signals. If you're getting it, if it's in the red bearish phase, then you would basically skip those. You could theoretically skip those buy signals. I mean, you can just historically look, you would have skipped this one right here, and you would have made, a little bit of money on the bounce, or could have theoretically at least, but it really didn't go anywhere until it finally did, of course. But you would have held through a few days, or what is this? This is a few weeks, a few weeks before it finally paid. So that, when it's in that bearish phase, that can be since you guys can't short, for me, when it's in bearish phase, I'm just selling. I'm just going the opposite direction and betting on the price falling. But since you guys are basically only exclusive to buy signals, then I would just use that as your guide. When the buys are kicking in, then any of these Fibonacci levels that are, showing an obvious history. So like if we go out to the now, right, we're kind of, now you can't see the levels. Hold on, there. So we're sitting on a 382, which, without getting into that either, that's a very common retracement level. That's, after a strong rally like this, you would almost expect a 382 retracement, just kind of mathematically. Anyway, so, but you've got this, your other indicator here is bearish. So even though we're dipping back down towards support levels here at the 50% level, like right there, I would argue you're better off to just exclude any of those potential buys, because this 50% level is, it was a resistance level. And so therefore, now that it's been broken through, it's now a support level. Resistance becomes support, support becomes resistance. Once it's breached, it becomes the opposite. So that would, the 50% would be a valid new buy point for people if they wanted to take that long trades, but I would use this as the filter. So until it turns green, I would exclude them. That makes sense?
Yes. What is the pink line?
Pink.
Can y'all see the big pink line right
Are you
across?
talking about the dotted line here?
Yeah, what is that line?
Isn't that the current price? I believe that's the current price.
Ah, I see. And what is the relationship to the robots in all of this? Like, I know that there's the human emotion that's affecting all of these buy and sells, but now that there's all these robots hooked up, how is this affecting all of this as far as that goes? Are
Well,
they
I mean, the bots are all still programmed by humans. And B, and B, well, I mean, I guess some of the AI stuff is now writing its own code, but still, the source code was still human. And B, at the end of the day, it is still a human endeavor, right? Because we're still just really charting. There is no such thing as price. It's just belief. It's just what we believe. You know what I mean? At this moment in time, we all collectively believe that Ethereum is worth 134.90. That doesn't make it true. And in 2 seconds, it's going to be worth something else. You know what I'm saying? So, and at some point, it's probably going to be worth millions of dollars, and at some point, it's probably going to be worth zero, just like everything else. So, you know what I mean? It's not, and the path between both of them is going to be wild and crazy. But the I get what you're saying, and I struggled with that too for a while, in the sense that I was seeing the same thing where it's like everything is going bot, everything's going electronic, everything's, because I lived through the whole changeover. I started out when we were still actually, when you actually called your broker, and then your broker called the trading floor, because I was the broker, so I was calling the trading floor and actually executing the trades over the phone, screaming into the phone like the old, fashioned days, like the Wall Street movies and stuff. And and then of course everything went to the computer, and then everything went to algorithms, and then everything has now gone to bots. And frankly, like I said, I've been doing this 30 years. I've expected it to have changed, and nothing. I literally mean nothing has changed. The chart patterns are all still the same. They function exactly the same. So whatever it is, it's having zero effect, in my experience, at least. I mean, there is, when you're down at the hyper level, of trading, where you're trading on the picosecond, and all that kind of ridiculous stuff. Sure, obviously only the bots can be trading at that level, but at that point, all they're really doing is arbitrage anyway. So that's not really, I mean, it is real trading, but it's not real trading in the sense of you or I could ever actually do it. So that it has to be essentially done electronically. Anyway.
Can I ask you one more question about this while I'm looking at it, while I have the floor? Okay, do you see the bottom red waving line, and then you have the top waving green and red line, right?
Yeah.
Okay. I've been making some confusion in my trades this week, because what is this waving red line? Wait a minute, y'all just moved it.
Yeah, I mean, like I said, that's the crypto girl's
Yeah.
gonna have to kind of speak to that more than I can right now.
Yo, what's going on here, what you just did? Because I have actually made some mistakes in my trades, because maybe the Fibonacci was off, and that there was what looked like the price line, but it really wasn't the actual price. And then there was the candlestick line on another line, and
Yeah, I can tell you how to fix that, and simply, like, see what I'm doing. All I'm doing is I'm taking my mouse, and then I'm pushing down on the button, and so I can drag it. And all you basically have to do is just take wherever current price is and line it up with that red line.
with which red line?
that bold center red line.
What? You line it up with the price?
I mean, Crypto Girl, you're gonna have to tell me if I'm wrong, but for me, that's the center point. So then you've got your deviations, your Fibonacci deviations away from current, right? Or away from current price. I mean, the center line's basically some form of a smooth moving average. Looks like exponentially smoothed.
Because this has been happening all week. I'm doing paper trading, and I've been watching the red line and what it's doing, and I would place the trade without really looking at, what the number was. But then when the trade would come in, it was actually much higher than where the red line was, and I'm beginning to wonder if I've had my chart lined up wrong for a week.
Well, like, go ahead, Crypto Girl, because I mean, I might be doing it wrong, but like for me, that's the center point. So I would be basically just to give you a a starting point to put it right there.
Is that
I
it?
think that this is really good that we have Derek on the phone, and I wish Joe was here too, because I can't speak for Joe because he created the fib lines the way he did. But I think what's important here is that we have Derek to actually tell us with the fibs that he placed on this particular chart. Let's just kind of see the comparison to the fib lines that are there versus the fib lines that you've placed, Derek. You see, like,
Well, so I mean, I can see kind of what he did. I've coded a lot of this stuff myself. So the center line is, is some kind of an exponential moving average. It's heavily smoothed, which is normal. And then, he like obviously took the Fibonacci and either did like a normal bell curve with a standard deviation out, on both sides, and then embedded the Fibonacci level into that, or I mean, it could be, it looks to me like it's kind of constructed similarly to a Bollinger Band, but instead of a Bollinger Band only uses standard deviation, he used Fibonacci. I could be wrong, but that's what it, looks like to me. So if it, like, okay, how about I do this? If I was blind and I never used this before, which I haven't, for me, the way I would use this is, this is telling you, if nothing else, it's telling you what your risk to reward situation is. So right now you've got this bearish indicator, right? But you've got current price, this purple line, like we said, 135, nice and even, perfect. So now look at where the first green line is 150. Let's just round it to 150, okay? And now look at this. This first blue line is down here at 114. So 130 or 115. 135 to 115 is 20. We can all do that math, even me. And 135 to 150 is 15, right? So what does that tell you right there? Let's make this a quiz, pop quiz. What does that tell you right there?
that you're going to risk 15 if you do the first stop loss, and you're going to resist. What was the next one?
Almost, you got to reverse. You're going to risk 20 to make 15. So you're in an inverted risk to reward ratio in that case. So that's the second reason, besides the bearish indicator, that thick red line that you guys have on there. Besides that, the second reason I wouldn't be thrilled about taking a trade in that right now is because your risk to reward ratio is inverted, is backwards. Now, if it was the other way, if you were risking 15 to make 20, that's a positive risk to reward ratio. That's great. You want to take those kind of trades all day long. You do not want to be risking $20 to make 5 or 10, because statistically speaking, you're probably not going to win a heck of a lot more trades than you're going to lose in the long scheme of 1,000 trades. You're going to have lots of losers along the way. Everybody does. There's no way around it. So the way to make sure that those losers don't take you out from being a trader anymore is to make sure that they're small along the way. And so the way to manage that is to monitor what your risk to reward ratio is. You always have an idea of what your target is, right? So you also have to have an idea of what you're willing to risk to reach that target. And if it's more, I mean, why would you be willing to risk more than you possibly stand to gain? That's like those people that take that crazy football bet or whatever when the odds are terrible and they got to put up $200 to win 50. It's like, what are you doing? That's the dumbest thing I've ever seen in the world. You know, no disrespect, but come on, seriously, get a calculator. Like, that's not going to work over the long run. How many times do you got to lose before you're wiped out versus how many times you got to win? Anyway, so that's the first thing that this tool does for me without even using it for buy and sell signals. It's immediately giving me a way to assess my risk to reward ratio, which I like. I like that.
Very good.
Now, Derek, would you take that top Fibonacci line, which is the top green little line that goes above and beyond the red Fibonacci that you've got overlaid? Would you take that as your take profit, or would you would you go in between those two take profit lines?
So for me, it's a function of my risk to reward again. So let's pretend it's the other way around, and let's say I'm risking 15 to make 20. All right. So I'm always going to manage my risk. Let's see, the simplest method that I've ever used, and it's always usually the best. And like I said, I've made the risk matrix super complex too when it doesn't have to be. And so for me, it's simple. Okay, if I'm risking 15 points, whatever, $15, 15 Bitcoin, whatever, doesn't matter. If I'm risking 15 of anything or X of anything, and my target is Y, I'm trying to make 20, right? If I make 50% of the distance to my target, so in this case, I'm trying to make 20. So let's say it moves from 135 to 145, right? I'm 5 points away from my target at that 150, no, sorry, I'm using a 155 target. So I'm 10 points away from my target. And so I'm 50% of the way to my target, right? I'm now gonna move my stop, which was at that, 15 points below, up to break even. So I'm going to remove all of the risk out of that trade. Now, does that mean I'm going to get stopped out prematurely and whatever and end up making nothing on the trade? Maybe. I don't know. But I'll tell you what I'm not going to do is lose money. So so that's my hard and fast rule. As soon as I've reached 50%, and I've messed around with that percentage, God, for years. I've all the way down to 25%, or well, actually 23, just like it says on the FIB thing, 236. I'm a little superstitious about numbers. Well, I'm not superstitious because it's bad luck. But anyway, I've like I said, I've used every number from 236 to 786, and it actually works out best around the 50% level for me personally. So that's what I stick to. So when I hit, like I said, 50% of the distance to whatever my target is, then whatever your original risk was is removed, is erased. And that's your job as a trader. Like, your job is to find opportunities, and then obviously to take that opportunity, you have to assume a certain amount of risk. But then your real job, once you've done that, then you get down to real work, which is removing that risk and still allowing the opportunity to persist. And that's, you know what I mean, the real game. Now you're trading risk-free, and then you can let it ride, like you were saying. If you want to use that second target, like you were saying up here, I'll drag it so it makes more sense again. Then fine, because you no longer have any risk on the trade. So you can hang on to it as long as it goes, as long as it, whatever. It doesn't matter anymore. You have no risk on the trade. So at that point, you can manage your own personal greed however you see fit, but you've done 99% of the job of a trader, of finding the opportunity, taking the risk, and then sensibly removing that risk once you've had a decent amount of profit. And at that point, you can start scaling out of the trade. Let's say you have 10 shares or 10 Bitcoin or whatever it is, or 10/10ths of a Bitcoin, however, whatever. Since you can take it down to the eighths of that decimal place, I mean, you can chop it up into as many little slices as you want, and you can start scaling out. So that's the other thing that I would do normally is when I hit that 50% level and I move my stop up to break even, I'm going to take a little bit of profit. You know, take 10% or 20% of your position and dump it. Who cares? Now you're guaranteed to make money on the remaining trade. Even if your stop loss gets hit, you're still going to have made that little bit of profit on the whole trade, and you live to trade another day with a little bit more money in your pocket. So again, who cares? You do not sweat or fret about trying to hit. It's not about hitting home runs. I promise you, it's not about hitting home runs. You're only going to hit a few home runs in your entire trading career. The rest of the time, it's all singles and doubles, and the occasional triples. So you better get used to, you know, swinging for the singles and the doubles. And that's like I said, that's what you're really trying to do is find that trade, get in it, and get out of that risk as quick as possible, and then start ringing the register, taking profits, and pat yourself on the back every time you ring the register. I even my old computer, I used to have it literally when I would hit the sell button, it would go cha-ching, cha-ching, and it would remind me that, you know, hey, this is how we get paid. We don't get paid sitting in the trade watching it go up. We get paid when we get out. So anyway, I've probably monologued for long enough.
No, that was great. And we have Donna's unmuted, and so is Renee. So they both want to talk to you. If it's okay, I'm going to let them ask you questions and keep talking.
Go ahead.
Go ahead, Renee.
Okay, go ahead, Donna. I'll make sure Renee's unmuted.
Okay, so did I understand you to say that okay, so you go in the trade at 0.618.
In this particular case, it's like here, let's do this in real time. Pick a market, any market, I don't care.
Can you hear me?
Crypto, because that's where we're at. So can we go to maybe Bitcoin?
Yeah. Okay. So same thing. I'm not going to.
Hold on a second. Notice how these Fibonacci lines are way below the actual.
Yeah, and I don't exactly know exactly how or why his overlay is like that. Joe would have to explain that.
And then the other.
There very well could be probably is a purpose to it, but I'm not.
Can I help you with this problem?
Hey, yeah, go ahead.
Okay, hi Derek, this is Renee. The red line from Joe's FIB lines is the 50% level from our from our FIB levels, and if we try to match it up with the manually drawn out lines from the left menu from the retracement Fibonacci's, then we have the right point, I think.
So would you show us what you're talking about visibly?
This thing doesn't want to.
Donna, I just love you on this thing.
I'm sorry.
You say what I'm thinking sometimes, so I just let you say
Like a
it.
bulldog. I've been driven crazy by this in the last week, making a bunch of bad trades, and it's all because I'm just not reading them right somehow. Between the Fibonacci's and that price line, you know, the one, something's gone haywire in my brain.
You're just a dream student because I was always the one in class that asked the questions. So you're just like me. But everybody's learning from you. The shy people are not going to ask questions, and we have a lot of people on right now, but no one's asking questions. So they're learning from you.
If I'm a little too much, just let me know and I'll chill out.
No. I mean, they probably need to know this, and they're probably asking it, but some people have a difficult time putting the words.
Yep, but you see what happened was for the first 2 weeks, I had several trades, couple of pages, everything green, even if it was just $50 to $100, you know, it was a lot of trades that were green. And then last week, I did some zooming in and zooming out. My Fibonacci's ended up in weird places, and I was misreading where the price line, that one of the red lines is versus the other red line, and the next thing you know, I had 4 or 5 trades where it was way up in the sky. I mean, it was like, what in the hell did I just do? How did that get up there? And so it's obvious that something's gone haywire in my understanding of, especially when the charts are volatile. So that's why I'm glad we're having this conversation.
Which, and maybe with the Fibonacci lines needs to come a little user-friendly clause saying that this only works on the 1 hour chart and you have to be spread at a certain level where you can't condense the chart.
Yeah.
Like I've noticed when you condense the chart, and I condense the chart, those fib lines move. And sometimes, you know, if someone's been using this technology so long, they forget to tell you those little baby things that make a big difference.
Yes.
But that's why I think it's good Derek's here, right? So at least you know you can test these lines. Did you see how Derek pulled the Fibonacci from the left-hand side, those little lines?
Yeah.
If you want him to do it again, he can do that again.
That he was on. How did he do that, by the way?
Derek, could you?
Yeah, it's real easy. All you do is it's right over here on the left. Just expand it out. It's just called the FIB Retracement. There's all kinds of other fib tools, and you can get, like, just like I said, you can take it too far. So, but yeah, you know, whatever. To each his own. I can say that as someone who has taken it too far. So,
Derek has read over 1,000 books on trading.
What?
Yeah.
Yeah, I did. In my 20s, I read over 200 books that were, and from the age of basically 26 to 28, it was really only 2 years. I went crazy, and I read almost on a daily basis. I would devour a book, and I read every single book. The only prerequisite was it had to be written prior to 1900, and it had to be about finance. And I'll tell you, if you read the historical books about trading, and there are many, you know, this is not new. I'm talking 1600s books and stuff like that. It's all the same. Nothing, it says it in the Bible, nothing new under the sun, and it's absolutely right. It's all the same. It's all just been recycled because, like I said, the underlying truth is that it is a chart of human emotion, and human emotion hasn't evolved 5 seconds. Okay? We are still...
Oh, wait. This is great for Donna. Donna, now I know you can't tell us specifically what your clients come to you for, but do you see a pattern in all your patients in certain age ranges and stages? Do they all have the same issues?
Absolutely.
So what Derek is saying is validated because you're working with psychology and you're working with human emotions. It's the same.
Profiling. I have my own 5-line Fibonacci.
You just go, wait, I know what you mean. Take the Fibonacci and take it home and you'll be fine.
And each of the thing has a whole personality profile to it, and here's how they react. And so it's interesting that it's the 5 lines, and I have 5 types, and it's
5%. Oh, you're at the 50% line. You're hitting a boundary line. You're about to get triggered to go 100%.
Yes, and it's like you go bearish and you go bullish, you know, but you know, you're when you're bullish, you're operating out of your healthy self, and when you're bearish, you're like, oh dear, you're shooting yourself in the foot. It's very interesting. I find this incredibly fascinating.
You'll be like going into therapy sessions tomorrow, being like, all right, this is like a bear market. You need to just do your stop loss right now. Cut your losses now because it's going bad.
You're about to have a 618 retracement.
Do you know, like, it's like the arm and the length of your arm and your elbow? You know, Derek Fry says. Right. Oh, I'm sorry. Okay, go on. We'll be serious about trading now.
The thing that is happening right now with these fib lines of Joe's, as it's related to the mechanical fib lines he put up, I've been talking to Joe about this, and he's told me to just turn mine off until they could try to figure this out, because they aren't staying in their proper place related to the chart when you zoom in and zoom out. Now, the other thing that is I'm very interested to see about this is how to get this price line, whether you're supposed to move that price line to the current price or not. I don't know if what I'm saying makes sense.
The red line, the red 50% or
Yeah, I
line.
know what you're saying. I don't know if that's right at all. I just made my own leap there of how I would look at it, because like I said, it looks a lot like an old like a Bollinger Band to me, but with, like I said, with some Fibonacci.
If we position this red line on the green line below, then we are in the right position.
On the green line below, what does that mean?
The blue.
The green. He said green.
The red line from the FIB lines, from Joe's FIB lines, on the green line below the purple line, right?
Right there.
Right there. And if you can see now, the FIB lines making a little bit more sense.
Okay, yeah, that makes. I see what you're saying. I
don't. And now we figured out how we can fix this zoom in and zoom out problem.
So then, well, no, because that would be the 618.
Because
yeah, I guess this is a six. So this red line is the 50. Then this is the 6. This is the 618. This is the 786.
Yes.
And this is really the 38.
Yeah.
The 386, and then this is the 236.
Right.
Okay. I mean, that makes sense. Even though they're not quite lining up, it doesn't. They don't have to line up, but that would make sense. And that's why the distance between these two is. So in other words, you're always going to if you look at it through what I was saying before, as through risk reward, it's always going to be inverted, because these are always going to be a static distance away from each other, right?
Right.
Yeah. So then disallow what I said. Well, because it's always going to be that way. You know what I'm saying? So it doesn't. It's if it was a dynamic line and it was shifting, then it would be different, right? But since it's static, it's not gonna matter. Okay.
So when you say static, it's always going to be those.
Well, because this line is always going to be 0.38 away from this line, and this line's always going to be 0.618 away from the 5, or not away, but it's always going to be, if this represents 50%, this line's always going to be 0.618. This line's always going to be 0.786, and this line's always going to be 0.386. This line's always going to be 0.236.
Right.
So that's how that. So it's always realigning it to current price.
Okay, but let me ask a question. So you just said the red line is 50%, but let's look right now, and we see that Bitcoin is up there by the pink, and this red line is below the 50%. I mean, below that line. So what does that mean?
If you go into this trade at the 50% line, you are now in profit, and that is fine.
So you're using the 50% line as your buy line.
Right.
Okay.
So you have to wait.
So this is basically
until it gets to that
okay.
point.
I see what he did. Now it makes sense. So he took the 50% level and walked it forward, and then okay. That's actually, yeah, that's pretty cool. So then, yeah. So my underlying fib levels are not. They're never going to correspond with what this is doing right now, because they're not. They're static, and this is a little bit more dynamic. But okay, but that's what he's using as the trading rule, basically buying on the 50%. So you're assuming. I see what you're saying. So you're assuming a 50% retracement to get the buy signal.
Right.
So the only way current is touching the red line is if you've actually retraced 50% of the high. So in other words, I don't know exactly how far back his look back period is. Do you know? Is it like 28 days or any idea?
Yeah, I think it's 28 days.
Okay, it's usually, that's one of the defaults usually. So the you know why it's 28 days?
Mm-mm.
Because
That's
Not
it's
really.
February. Just kidding.
I'll tell you
Why?
why. I know exactly why it's 28 days. See, I know a lot about this, the market esoterics, and I'm not trying to toot my own horn. It's not something to brag about.
Yes.
But I've done a lot of public speaking at the trade, you know, the money show and all that, and the traders expos all over the world. And I can always like drive people crazy because I can tell people this. I guarantee you, you are using financial astrology in your trading right now. And I guarantee you are, and nobody even knows it. And the reason is everybody likes to use like RSI. RSI is like one of the first indicators you ever use. RSI, Relative Strength Index, is what it stands for. And what's its default look back period? 14. Why did he choose 14? Because 14 is exactly 1/2 of a lunar cycle. So the fact that they use 28 as the look back period in these other things, same thing. It's the lunar cycle. So you are using financial astrology in almost all of this technical analysis. That's what it's all based off of. So anyway,
It's 2 lunar cycles then, because 14 plus 14 would be 28, right?
it's, well, a lunar cycle is 28. And so 14 is half a lunar cycle. So the RSI is using a half a lunar cycle in
Where's the
its
moon on the chart?
I actually have charts that can show that. There's actually, you can see the flux lines of the gravitational waves as they cross through the Earth, through the Earth's magnetic core, and you can actually time the market movements off of when the Earth and the Moon are going to be in alignment and when Mercury's crossing over this, and it's all very physical. You know, I mean, J.P. Morgan, the man, not the bank, but the man who created the bank. He straight up is quoted as saying, millionaires do not use financial astrology. Billionaires do. His highest paid advisor in his entire life was, I can't think of her damn name now. It's a woman, and she was an astrologer, and she never left his side whenever he made decisions. It was always based on astrology, everything. And so, you know, you can take it for what you want, you know, laugh at it all you want, but these people are not fools. and it's in there. It's all in there. It's, you know, this like I said, it's that's why we use Fibonacci. That's why I explored my exploration of Fibonacci is what led me to exploring fractal geometry, and then that's ultimately what led me to exploring the lunar cycles and everything. It's not just the moon, it's everything, but the sun and everything affects it. But yeah, so one of the most famous traders that I've ever studied under, his name's Dr. Al Larson. I believe he's still alive. I haven't looked him up in a few months, but he's very old. And he used to work at Bell Labs back when that was a thing, back when it was a spy laboratory in the 50s and 60s. And he is the single most winning S&P futures trader with a documented track record that I've ever seen. I think that's in existence. Last I saw, he hasn't had a losing month in 9 years. And every single trade he does is based off of the cycles of the moon and the sun. And he does have losing trades, but he's never had a losing month. So, you know, again, scoff all you want, but there is something there. I don't know what it is, but
I'm not scoffing.
no, I'm not saying anybody is, but I know most people just, you know, love to make fun of that stuff, and that's why I always kind of like say, hey, you know, it's worth investigating before you before you throw it away. But
Even in the mental world, even in the relationship world as well. So yeah, it's real.
Oh yeah, there's no doubt about it. So here, well, let's do. Well, I was gonna show here on the Bitcoin thing, the same thing what we were talking about before. That these levels, and it's not just because you draw enough lines on the darn chart, and sooner or later they're gonna line up. But you'll notice that these levels are. Oh, and I flipped this around. So okay, when I was doing it before, I had it drawn from left to right, and this time I drew it from right to left. So depending on which way you draw it, it's either going to give you projections above or below price. Because we were in a bearish or are in a bearish phase, my brain defaulted to doing it the way projecting lower, looking for lower prices. So that make any sense at all what I'm saying?
That again? What are you saying?
He's used to doing shorting, which means that you
Well, it's not
bet
just
that the
that.
price is
It's
going to go
not that
down.
I'm just used to shorting. It's that this because you're in this red line and you're in a bearish phase right now. The market's trending lower basically off of these highs. Um, the so that's why I had originally drawn the fibs this way, which I can just reverse it. Whoops, like this. So you see how it's projecting lower? Because you can use these Fibonacci levels not only as the retracement levels and using them as support and resistance and all that, but then there's also these future levels, these projections. So this is the 1618 extension, this is the 2618 extension. And so if and when the market breaks out of this current range that it's in, and it will break out, it always does, if it did break out to the downside, you would then begin to have a new target to where the new level of support ultimately is going to lie. In this case, down here to 2550, call it whatever. But that's all that's telling you is basically where other key points of future support and resistance are going to lie. So if you want to use it from the bullish standpoint, we just flip it around and go like that.
What makes you create the decision in your mind as to which way you're going to look at it?
Well, in this case, your little indicator thingy. You see how your thick red line versus your thick green line? That's all. So I was just using that because that's I figured what you all are using. But in the old days, I would be looking for some of my more super simple chart patterns, like my 1, 2, 3 tops and bottoms again. Which, by the way, you have in here embedded in this thing. I don't know if anybody noticed.
The 1, 2, 3, top and bottom.
Here's your 1 point. Here's your 2 point. Here's your number 3 point. And you're just kissing, or just that last high just kissed the number 2 point, which would technically be your breakout. So you haven't gotten a signal yet, but if and when the market breaks out above this point, I would go long and I would run a stop below here, below the number 3 point. And then I would be looking for this, the target to move to at least the 1618 extension. And actually, I got to make it like this. Hold on. There. You got to get the 0 point back, or the 1, or whatever you want to call it, back to the high. So the real 1618 extension is whatever this is, 5,050, call it. So if it breaks out above here, then I would expect it to go here. Maybe not immediately, but ultimately find its way towards that level. Make sense? And not because I think anything or I care or I have any, nothing. Because Fibonacci says so. Because in nature, this stuff is just so embedded in it. It's like, it's more insane than sexual attraction, quite frankly. So there's nothing you can do about it. Nothing you can do to stop it. Yeah,
That's amazing.
Would you that 1, 2, 3 business? You were going so fast, I couldn't watch it. I couldn't see what you were doing.
All right, so it's really, it's literally the first. I learned it on my first day of technical analysis. The first thing I learned. I'm not joking, and it's now, like I said, just about the only thing I use after having gone way too far. So it's really simple. All you do is you find your most recent low. That's it. Most recent low. So where's my little text tool? I'll highlight it. text. So here's my, let's make it nice and big. And let's make it purty. Okay. So here's my number 1 point. Whatever this low is here, you can see it on the chart. So whatever that is, 39, 31, call it 3,200. And then I'm simply going to just visually look at where the next high is. After that, it has to be in, forward in time, not backwards. But moving forward in time, what's the next most recent high? Whatever it is. I don't really care what it is, but whatever it is, it's right there. So you don't need any tools or anything to figure this out. You just need a set of eyes that still work, or even a good set of glasses. So there's your number 2 point. Real simple, obvious. And then look for the retracement. Now, lo and behold, if you measure with the Fibonacci tool, very often your retracement's going to be, a 618, either a 50% or a 618, sometimes a deep 786, but usually a 50 or 618. So here, I'll show you. Sorry, wrong one. Retracement. Oh, I'm doing it backwards, but let's do it that way. I don't know why this thing jumps around like that. Come on, just go to the low. There you go. This would be so much easier if it didn't jump. I'm just trying to stretch it out so you can see it a little bit better. But basically, you can see it was actually a 786 because it went down to the 236, which is the reciprocal. Anyway, so this is your number 3 point. The next recent low after, so you find the low, then you find the high, and then you find the next higher low, excuse me. It has to be above. So if it's a new lower low, if this low had come down below this number 1 point, then it erases and the count starts over again at a new number 1. But in this case, it didn't. And so, or at least not yet. So right now, at least this is our number 3 point, basically right here, somewhere right in there. And it's just called a 1, 2, 3 top or bottom. In this case, it's a bottom. But it works just as the same on tops in reverse. So if you want to know if the market's topping out, you just look for this pattern. It's almost impossible for the market to make a bottom or a top without this pattern. It's possible, but not likely. And that's it. So now you know where your number 1, your number 2, and your number 3 is, and that gives you everything you need to know about what to do in the future. So so here's what you need to know. The rules are very simple. You buy a break above the number 2 point. So if and when the market breaks out above this old high, you buy long. So whatever that number is, that's your buy point. And I would usually give it a few points above whatever that old number is, so you know it is in fact a true breakout to new highs before you get in. And then you're literally buying a runaway market at that point. Hopefully, I mean, that's the idea. And then your number 3 point, like I already said, becomes your stop. Some people will use the number 1 point as their stop. You can do that if your risk to reward ratio is good enough. So in this case, let's just do the numbers. Good old-fashioned numbers. So I'm just going to round to make things simple. Let's just call this 4,400, okay? And let's call this 3,400. So we have a nice even $1,000, okay? So that's our risk. If we buy long here and we run a stop here, we know we have to risk, excuse me, $1,000. And like I already said, our first target would be the 1618 extension, and at least for me. So let's just call that 5,200 to make it even. So what's that? 44 to 52. We can all do that math. That's 800. So right away, you know that this is inverted risk to reward ratio. So not necessarily attractive, even though you do have a good signal and a valid, all that other stuff is valid. You're still, when you're looking at your risk reward rate, so that doesn't mean you don't take the trade necessarily, but what it does mean is you're going to have to run a tighter stop than the number 3 point if you're really only going to use the 1618 as your target, or you're going to have to run a more aggressive target, which is statistically and theoretically less likely to happen. The further you're trying to get it to go, the less likely it is to go there. It's that simple. So the only way around that, if you want to force the issue and you want to take the trade, like I said, and there's nothing wrong with running a tighter stop, it's just you have to recognize what you're doing. The reason I like running the stops here from a technical standpoint, and it's not whatever, it just doesn't make it right, but from a technical standpoint, you're gaining new information, right? If this point is breached, if number 3 point is breached, well, that's a clear support level. The market has found support down here and bounced off of it, and it hasn't been able to get anywhere near here since then. So it's a support level, a turning point, whatever you want to call it. So a breach of that would be new information. So I'm gaining some new data. Whereas if I just willy-nilly put my stop somewhere else up here, somewhere else, and it's just because I need a tighter risk to reward ratio, well, if I get stopped out, I'm not getting any new information. I just got stopped out because my risk tolerance only allowed me to have that much. Now that's okay. It's better to err to the side of the risk tolerance side, but just recognize the difference, okay? Because here you're technically getting stopped out for a reason, because the market's actually breaching a technical point. Same with if you use the number 1 point. This is the clear support level. This is the most recent low we've had. So if this gets breached, then it's lookout below. So that's clear information, new information, and you'd obviously want to take that into consideration. And it's not obviously the best time to be long when the market's breaking down. So so that's why technically you're using those as your stop points. It's so that it's not a willy-nilly thing, so that it's not. That's the problem with a lot of investment strategies where they'll give you some static risk to reward ratio, and they'll say only risk 1% never risk more than 1% of your account in any one trade. That is good advice, by the way, but if you take it to its mathematical stupid point and you literally lock that in and don't take into account the actual technical nature of the market, then you're arbitrarily creating unnecessary losses for yourself. Do you know what I'm saying? Like, because you're just saying, well, I'm only allowed to risk 1%, so that means I got to put my stop here. That's great. That's theoretically good risk management. But if you had just paid attention to the market and realized, the difference between your little 1% and the actual technical point in the market might be another 0.5%, might be more worthwhile to risk that extra 0.5% to get that that actual technical feedback, have a real reason to have your stop there rather than just a fixed dollar amount. You know what I'm saying? Like a real technical thing.
Yeah.
Rather than you just imposing your own will onto the market. When you're using the technical places, you're actually saying, okay, well, I'll bend with you. You know what I mean? Like if this is what you need, then I'll bend with you. But otherwise, you're just saying, nope, you must play my game, and the market's probably never going to play your game. It's going to play its game.
Very, very helpful.
Yeah, it's like accepting reality. So when people go to Donna for psychological, soothing, she's like, hey, accept your reality. And then once you accept you have an issue, then you fix it. So it makes total sense.
So anyway, yeah, I've monologued for quite a bit. So that's
So Richard Bannister said, can Derek recommend The Master Swing Trader by Alan Bailey? And he's unmuted if he wants to talk.
By Alan Farley.
Oh, Farley.
I'm not familiar with it, so I couldn't say. I don't know anything about it.
Okay, so do you have a book that one of the ones you read that you'd recommend, just swing trading in general, for any of us to read?
Sorry, I just ripped my headset off there.
I get so excited.
Yeah, no, I was just trying to reach over to my little library here, and I'll tell you, yes, I have a fantastic book for you to read. You might not think, you might think I'm giving you the wrong recommendation here. It was written in 1841. It is,
Yes.
you can get it. It's written by Charles Mackay,
Is that MC or MAC?
Mackay,
Got it.
and
Yep.
the name of the book is called Extraordinary Popular Delusions and the Madness of Crowds.
Love it. Extraordinary.
Popular delusions and what is it of crowds?
And the madness of crowds. And it really is a book. It's not about just trading, but it does in very great detail explain the tulip mania back in the 1600s in Holland,
Right.
as well as some other things too. So it does actually talk about trading, but it's the best book I've ever read about the reality of trading by far. But it's not a trading book.
Would it be on Amazon or somewhere like that, or is it
Yeah, you should be able to pull it up. I mean, like I said, it's an old book, but they've been reprinting it now.
Okay.
You know, so
I do want to ask you, and I know we have to jump off because we're getting late, but I worked for a very stout person, and he was like the CFO in pretty much every major bank in the United States. And I asked him about Bitcoin, and he kind of gave me the cold shoulder, and I was really like I was working with him on an event, situation. I was an event planner, but I was getting into crypto, and he said, it's tulips. And I was just mad. I was like, are you serious? I mean, he was literally, I guess, the people that signs the dollar bill in the United States Federal Reserve, the secretary or whatever. So at one point, what is this tulip thing? Like, he just denounced Bitcoin, but he was specifically working for banks and in China too. So with this Charles Mackay, the tulip mania, what is that? Why would a banker be telling me that Bitcoin is tulips?
well, I mean, it's a metaphor, right? Because the tulip thing is, in Wall Street circles, it's a well-known. Everybody knows it. It's back then in the 1600s. To make a long story short, tulips went from what they are today, which is worth a penny or two or whatever, to thousands of dollars even back then. You know what I mean? And people were trading receipts of tulips, so they weren't even actually trading real tulips anymore. And it got crazy, to make a long story short. And then the whole thing blew up, and everybody lost all their money. To make a long story short, well, like I was saying earlier, everything is tulips in the long. It's not a question of every single thing is tulips. Every single thing will go to zero. I promise you, every single thing will. But there's going to be a cycle between birth and death. And that cycle for some things is a day, some things is a week, some things it's a month, some things it's 10 years, 100 years. And, we don't know, frankly. So yes, he's on one hand right, but on another hand, there's an entire cycle inside of that, you know what I mean? We've already seen Bitcoin, make and break many, many millionaires. And it's going to do it multiple times over, even if it never goes back to the old highs. It doesn't have to. It's just this, you know what I mean? Just the cycles alone and the fluctuations alone that we see on a day-to-day, week-to-week, month-to-month basis are enough for people to, I mean, I guarantee you, just from this point 1 to point 2, many people made millions and many other people lost millions in Bitcoin alone. So it's not like, you're not going to hear about those stories because there's no sexy headline to go along with it, because it's not a new high or a new low. I mean, an all-time new high or new low, so nobody cares. But I mean, literally, it used to drive me crazy with my old brokerage firm. I would be, in the middle of trench warfare, literal trench warfare, in the gold pits, and literally make or lose $1 million inside of 2 hours in the damn gold market on a stupid $20 price fluctuation. And you know what I mean? Like, it would feel like the world's biggest event to you, and then you turn on the TV and it's not even there's nothing. You know what I mean? Like, there's not even a mention of the price of gold. Nobody even cares. And yet, you know what I mean? Like, literally millions of dollars were at risk and at stake, you know, to me and the clients at any one time in just that few hours. You know what I mean? So it's all relative. You don't need, you know, these massive price runs. You can make tons of money in just these small price fluctuations, because all of this stuff, you know, the market, everything in nature is fractal, and the market is a construct from humans, so therefore it is also fractal by nature. So all of this stuff scales fractally, just like everything else. So everything should work. You know, if you want more opportunities, if you're bored, all of this stuff works on the same on the 1 hour as it does on the 1 minute. I'm not talking about Joe's stuff. I'm talking about my stuff, right? The old-fashioned stuff. It's irrelevant what time frame you're on, unless you're down to, like I said, the picosecond, and then you can't function down there. But the same exact chart patterns are going to be here on this time frame. You just got to scale it out, you know, expand it out so you can actually see them. And you know, you're going to find the same 1, 2, 3s. You're going to find the same support and resistance. You're going to find the Fibonacci ratios. They're all going to work in the same way. There's nothing different. It scales fractally, as above, so below. It has to. It doesn't have a choice.
Well, to close this, I think the most magnificent thing that you said that touched my heart was the cycle. You know, it's like that dash at a gravestone. They're dead, but they did live, and that dash between like the birth date and the death date, that's that life they lived, and that's that story, and that's
Yeah,
that energy.
exactly. And it doesn't matter. I mean, it's not, Bitcoin's not going to go to zero tomorrow. That much I'm certain of. And
Yeah,
you know,
here's my perception of Bitcoin. I don't think that that's going to be the last currency we have. No, not at all. I think that each country currently is creating their own currency, that we will be going to digital currency. That is 100%. I'm certain that the paper money will be disappearing as faster than donuts at a police convention. Like, that's over. Because it's trackable, it's totally controllable, and you have 100% taxable. You know what I mean?
yeah, they can just shut you off. That's the whole
USDC coin is totally embedded with all this programming, blacklistable. And so that was the first one. Poloniex was like pushing it. I thought, Jiminy Crickets, where is this going? And you have Ripple, so that just basically shows you, look, you can make something that the banks are about to blast out to the world and adapt through. There's things saying that, not Wells Fargo, but Western Union will be adapting Ripple and using all this technology. So it's just a matter of time when all those things come into play, if they're not already in play. I mean, which reduces the cost of doing business dramatically, opposed to paying $30 for a wire transfer and it costs them 0.003 cents like the EOS technology does. So, but they're probably not going to reduce the cost of doing business for us. They'll keep connecting, just charging the same thing, but their business cost is going to be nothing. But here's the thing, with the technical potential, like long-term HODL calculator created, like if it goes to the all-time high, if we just hit basically 1 trillion in the crypto land market, what happened in the past to those like top 50 market cap coins, the multipliers are huge, but the Bitcoin multipliers are nothing compared to what the altcoins. The altcoins wrote right below Bitcoin, like the top, say, 20 market cap coins. Those potential gains, if we just hit the all-time highs, are like probably 15 to 20 times higher than the Bitcoin. So if I was going to do any all-time long-term hodling of anything, I would be buying the altcoins right now and holding versus anything. Now, guys, heads up, Derek does not believe in hodling. He's a swing trader all the way. He's an in and an out, and that is it, right? Tell them your perspective, and then I know we'll jump off.
Yeah, I mean, I can't even tell the number of horror stories. So I don't like to hold. I definitely don't hold trades over a weekend, because that's insane. But too much can happen, and you don't have any control. I mean, in Bitcoin world, it's different because it never shuts down. But I'm used to the old futures world, and so we actually, the markets would close. But So it's a little different in crypto because it's never off. But I don't like holding trades for very long at all. You know, I expect my money to perform. You know, I'm not in it to. I'm not in it. I have no emotional connection to it at all. Less than zero. I mean it when I say I don't care. And that's, I think, important because it allows me to make clearer decisions, really, because I'm not emotionally involved in the money. And it's not because I have a bunch of money or anything like that. I've simply made the decision not to be emotionally involved in money because it's not a good thing. And you know, I mean, I don't want to digress too much, but yeah, I used to do a whole speech on this. You know, I mean, when you click the mouse button or the keyboard, whatever, to enter your trade, no matter who you are, and Donna, you can probably speak to this, your adrenal gland just fired off, okay? And you are now making decisions basically on the same level of a heroin addict, because adrenaline and heroin are only a couple molecules different from each other. And so you are basically a functional heroin addict the second you get into a trade. All right, am I wrong?
Donna, you've gone from counseling to
Yeah, so
Derek, can I jump in for a second?
yeah,
I want to pick up something you said, that you make your money when you sell. And the problem with the dot-com boom, the real estate crash in the US, and the tulips in Holland, people were holding, thinking it was going to keep going up, instead of selling and taking a reasonable a profit, and then maybe trading and taking profit. I managed to get out of the US real estate crash before it happened because it was a good time to sell. So my point is that I agree with you that if you hold for too long or too much without paying constant attention to it, it's much better to make money every day, and then you got money in your pocket or wherever. That's my
yeah,
little spiel.
yeah. The way I always try to explain it to people is if you actually look, like that's why I was down in the 1 minute chart, right? Like, so there's more money to be made down in here, and you don't have to trade the 1 minute. I'm not trying to say that, but it's just easier to elucidate on the 1 minute. You can do the same thing on a daily or a weekly, it doesn't matter. But there's more money to be made trading the back and forth, this little up, and then this
Yep.
little, and then this little, and then, not that you're going to catch them all, right? Obviously not, but there's more opportunity in the minute to minute, hour to hour, day to day fluctuations than there ever is in those long term fluctuations. You know what I'm saying? Like, even if Bitcoin goes to $1 million, I guarantee you the guys that make the most money are the guys that are going to trade in and out of it back and forth each day and not buy at 3,900 and sell at $1 million. They're going to buy at 3,900 and sell at 3,950 and buy again at 3,925 and sell at 3,975 and so on, back and forth, all the way along. You know, probably never going to sleep, never going to bed with a position. That was one of my things for a long, long time. I would never go to sleep with a position on, and that doesn't mean I didn't sleep. It just means I was out at the end of every day. And no matter what, win, lose, or draw, you just close it out and you live to fight another day. No matter what, you either, you know, hit your target, hit your stop, or you just get out at the close. So yeah, I mean,
I totally agree. Yeah.
yeah, it's not even a debatable point. There is more opportunity in those fluctuations. You can actually calculate it and figure it out. So, you know what I mean? Like, that's not a debatable point. It's just a matter of getting yourself. It doesn't mean you have to be a hyper trader either. It's just, you know, getting yourself out of that mindset of, you know, oh, I want to sell at the high. You know what I mean? That everybody wants to have that stupid cocktail party bragging rights that, well, I sold Bitcoin at 20,000. You know, okay, well, you can take your 20,000 and cram it, tough guy. You know, none of us want to hear it. So yeah, you know what I mean? That's not trading, that's ego. You know what I mean? Like, a trader doesn't care about that. You're not trying to brag, you're trying to make money. This is your job. You know, you don't get paid to go bragging. You get paid to ring the register. So anyway, yeah, that's there's way more opportunity in the fluctuations. That's why I learned to trade the the simple basic back and forth chart patterns. And like I said, the 1, 2, 3 bottoms and tops, so simple. They're everywhere. They're undeniable. There's no way to disprove it. I mean, it doesn't work all the time. From time to time, you get stopped out, but there's anyway, depending on what your rules are, there's anywhere from a funny enough, about a 62 to 78% edge. Funny enough, that falls in between the 0.618 and the 0.786. But anyway, when you're using the 1, 2, 3 tops and bottoms, they're going to work out 2 out of 3 times, basically. So that's pretty darn good odds by any measure. And then just a simple amount of risk matrix rules behind a simple strategy like that is really all you need. You don't have to make it any more complex than that. Trust me. And that's it. Keep a good mind of what risk reward ratios you're in. Don't be getting yourself in. I mean, the occasional inverted risk reward ratio isn't going to kill you, but if you make a regular practice out of it, you can do the math and think it through. If you're risking $5 to make $2.50, how many times in a row do you have to lose before you're wiped out? It's not many. And it's just simple things like that. It really is. The trading is not hard. The hard part is to get yourself to do it repetitively, because it's boring. It's extremely boring to be a successful trader because you're not getting emotionally involved. You don't care about the price. You're not interested in the news. I don't watch any news. I don't read any headlines. I don't even have TV. That's how much news I don't watch, and I don't get any papers. I used to be interviewed and be on the stupid front page of the Wall Street Journal, and I didn't even get the damn thing. So none of that stuff is important because, like I said, at the end of the day, that's all embedded into human emotion, and the cycles that we go through, the fear and greed and the panic and all that crap, it's all been done before. It's not new. And we are not experiencing it in any different way than anybody else has, and we're not going to have any sort of different response to that external stimuli than anyone else historically has had. I'm sorry, I'm an evolution denier when it comes to human emotion. We do not progress at all. We do the same thing over and 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 over again, and that's what shows up as repetitive chart patterns, and that's why they work.
Donna, do you back that?
Yes, but that's the whole point of, just like when a person works on one of their patterns, it's the same as working these patterns so you'd have more wins instead of just doing the same old thing over and over.
I think that's great. The other thing, I'm glad you touched on that, Derek, is I want them to understand that Derek does not care about the fundamentals of these coins either. Like, people would bring him charts and ask him his opinion. He said, take the name of this particular stock off the chart, because I don't care what it is. I'm specifically looking at the chart, reading the chart, and looking at the patterns. So when sometimes I'll say, oh, EOS or waves, or these are really good fundamental projects, whatever the product is, the project, the technology, he doesn't give a flip.
Yeah, I don't care. I don't even want to know. Don't waste my time. I'm not interested. It doesn't mean anything to me. I call it fundamentals, because it's, the story always changes, but the song remains the same.
So I'm wondering, the chart that you've got up right now, what's the 1, 2, 3 on this chart right here?
Oh, I was just messing around there, just playing with the chart, but it's just this is a 1 minute, so I was just kind of showing that fractally. I was trying to elucidate that the market scales fractally, so I just took it down to 1 minute from a 1 hour.
But what is that?
And that's just on this particular 1 minute chart. This is your low, so that's your number 1 point. That's your high, so that's your number 2 point, and this is the number 3. So same story. I would buy a breakout above, and in this case, you're going to get a good risk to reward ratio. I can see it already because the distance between the 2 and the 3 isn't very deep. I have this thing flipped around, so I'd have to flip it to show you here, but come on.
It's like a $300 spread from like the number 1 and the number 2. It was 3,700.
There. So there's your number 3.
3,750.
So there's the 1618. So call it 41. We'll round down this time. And what's the number 2 point? 39. Call it 40. So so $1,000, and you're risking about 1,000. That's a 1-to-1. But that's not terrible. At least you're, staying
That's a
even
lot of
there.
fluctuation with the minute charts.
Yeah, it's I'm sorry, it's $100, right? Yeah, it's $100. 4,000 to 4,100, and 4,000 to 3,900, roughly. I'm just kind of rounding, but
Oh, yeah, I see it.
but yeah, it's basically a 1-to-1 risk reward ratio, which is all right, like I said. I mean, I honestly would like to. I always wanted to try to get a 1.5 to 1 risk reward ratio if possible, because then you can just do the math. You can lose a lot of trades if your average risk reward ratio is 1.5 to 1. You can lose a lot of trades and still be alive. And that's, you always hope for the best but plan for the worst, right? So that's the way I've always done my math.
I want you guys to make sure you remember this risk reward, because Derek is huge. That's the only thing that he really cares about, is what's your risk tolerance level. And I
Yeah, I mean,
love how you.
that has to be the baseline. Like, I can't. It used to drive me crazy when people would bring me, their whatever, their biggest opportunity, and they'd be like, oh, look at this chart. What do you think? I think it's going to go here. Like, I don't care where you think it's going to go. Where do you think it can go in terms of loss? Everything has to start there. You got to determine where is your loss point before you even care about your target. Your target doesn't mean anything without a loss point, because it lacks perspective. It's a meaningless number without how much are you going to risk. You can't. What are you going to risk? Infinity? I mean, come on. You're going to risk your whole account on one trade? That's not that's not a path to success. I guarantee it. So you know what I mean? Like, the only way to have any realm of perspective of, is this a valid opportunity, is to measure it against the risk. There is no other thing to measure it against. You know what I'm saying?
Yeah. Awesome. Guys, do you have anything else you want to say to Derek before we jump off?
Thank you. Thank you so much. Incredible.
Thanks.
No problem. Happy to help.
Really.
So much. Yeah. Did you guys like him?
Yeah, Derek, thanks
Yes.
very much. It reminds me of the saying about the wealthy. The successful wealthy know how to not lose their money.
Yeah, that's exactly right. Job number 1, when you're a fiduciary, when you actually manage other people's money, nobody cares. Like, billionaires and stuff, they never ask about how much they're going to make on a return. When they're investigating you about whether or not they're going to give you a single penny, the only thing they care about is the return of principal. Are they actually going to get the money they gave you in the first place back? Let alone any gains on top of that. So, when you realize that's the primary objective, it kind of fundamentally shifts what you're looking at. You know what I mean? And it's like, oh, you don't care if I make money, I just can't lose any. Okay, I got you. You know what I mean?
That totally makes sense.
So yeah, that kind of shifts your perspective a little bit. And then, if you look at your own money as if you were managing other people's money, and it'll change your perspective too. And it should not make you more cavalier. So not when you're a fiduciary, because your butt's on the line. So anyway, that's enough about that.
All right, guys. Awesome. Awesome.
Really. Very powerful.
Penny said amazing. Renee said risk management. Roger said come back again. And Cynthia said no more questions tonight. Thank you.
All right, guys. Well, it's been fun. Have fun out there. Be safe. And yeah, just I always say, I love that saying, the KISS saying, keep it simple, stupid. It really, everything you needed to learn, you learned in kindergarten. It's the truth. The more you keep it, and I'll end it with this. The reason that simplicity is key is not just because anything else. It's because the simpler you make it, the more likely you are to repeat it. And this game is all about repetition. at the end of the day, like I said, it's going to be boring. You're going to do the same thing 1,000 times over and over again. You're never going to know what the outcome is in advance, and you're never really going to care, because at the end of it, you're looking back at your whole sample and saying, hey, look at that. I won 62% of my trades. I made whatever amount of money, and great. You know what I mean? But each individual, the other analogy I use, and I'll totally close with this, is if you're a gardener, you know, or a lawn guy, where would you be as a lawn guy if you cared about every blade of grass? You wouldn't be a lawn guy for very long. You know what I'm saying? You need to care about the whole lawn, but you can't care about every single blade of grass. Some of them are just going to have to get trampled or whatever. But, you know, so anyway, it's about the whole thing. It's not about each little piece. All right, guys, have fun.
Yes, you guys
Thank
too.
Derek,
Thanks so much.
Please come back.
I know, Derek, will you come back? I'm glad Joe was sick.
Yeah, anytime. Just let me know.
Awesome. All right, guys. And I'll send you the replay tomorrow, probably.
All
Oh,
right.
and Derek, is it okay if I give them your email address in case they want to just do some coaching with you, or are you available for that at all? I know that you're busy.
Yeah, I do still do some private coaching if anybody is interested. It's, you know, it is what it is. It's not super cheap, but I'm happy to discuss it with anybody if they'd like. So yeah, if you want to give out my email address, feel free.
All right, I'll give you guys the email address in the replay email. All right, so keep an eye out for that one.
Thank you. Good
All
night.
right.
All right.
Night, guys. Thank you.
Night.
Bye.
Bye
good
bye.
night.